us.
Good morning.
I look at the index, we are down just 1% for the year. In a year where whatever could go wrong has gone wrong for us. War, inflation, scare by central bankers, and yet markets are almost flat.
So actually, you look at emerging market context, India is a star. So look at, say, MSCI, Korea,
I like
Taiwan, China,
India is
all
a star.
down 25%. Emerging market index down 20%.
Yeah.
India's down 6-7%, broadly currency.
Absolute is 1% approximately.
Yeah, so actually you look at India and you think, wow, we are stars. And honestly, I think the large part of the FIS selling that we have seen, at least my view, is a collateral damage because emerging markets are going through crisis. You look at the index for the last 15 years, I'm talking MSCI emerging market for the last 15 years, they are flat, they've done nothing. My view is that this asset class is literally dead because if an index doesn't do anything for 15 years, and you look at the composition of the index, you have current account surplus countries, you have current account deficit countries, you have commodity exporting countries, you have commodity importing countries. You have country with per capita of $25,000 and country with 2,000 per capita. So it's the sum of parts is zero. If some country is benefiting, some country is losing. So if the index hasn't done anything for you, look at for 5 years, 10 years, 15 years, it's done nothing. So I think that people will start looking at country specific. For the same period, if you look at India's performance, India has done 7-8% dollar returns, compounded over a period. And I think this realization will come as I speak to more of my friends in the, who manage emerging markets, that clients are now demanding, emerging market ex-China, emerging markets or Asia with remove China because China nobody wants to invest now. And eventually we think that India's weight in the emerging markets also will continue to go up as the pressure to perform for this indices go up. So I think within the overall scheme of things, India is looking very good. I think the prospects for the next year, if you ask me, are looking even better. So we're quite bullish.
So will we only relatively look better, or standalone as well, do we have a strong case for outperformance?
So I think, as I said last time also, I think 22 is a tough year. And we are seeing that. I mean, the index doesn't show the pain that is in the portfolios.
Of course,
so you look at the performance of the index and you take the top 10 or top 15, they're mostly value stocks. I mean, you have likes of Coal India, NTPC, then you have some of these auto names, you have ITC thrown in, which nobody wanted to touch a year back.
6 months back.
Yeah, so I think the composition of the returns tells you that, there is a flight from growth to value. That's something which we've been playing. Fortunately, we've been on the right side, but not on all the stocks. Some values have also got crushed. Happy to discuss that also. But broadly, that's what we are seeing right now. We think growth will now slowly come back as we are seeing the economy stabilize. We are seeing tax collections better. We are seeing consumption numbers which are showing an uptick. We think growth will come back and there will be a shift back from value to growth, and we are possibly in that transition phase where growth stocks may start to inch their way back into the market, specifically the ones where earnings at least is visible. Where earnings is not visible, I mean, they may take some more time, but I think we may standalone also do extremely well, at least from 23 onwards, because 22 we still have a lot of challenges. Too many rate hikes expected, inflation numbers have to still stabilize. We don't know what's happening in Ukraine. So we may see this up down that we are seeing right now in the market. We may see a little more of that, but the base is getting set for 23.
But will growth replace value, or will both of them coexist at the top?
It's a very tough question to answer, but we are seeing, like, say, PSU banks, they are value, but we are seeing growth come back there because their provisioning numbers are substantially going down from, say, 2.5% provisioning to now maybe under 1%. So you will see profit growth there. Now, would you call that growth or values? That's a big question mark. So I think the traditional growth companies could come back. Value, where you are seeing earnings momentum, may continue to do well. So I think it will be it'll be a challenge for stock pickers, but if you can manage the environment, I think there's enough money to be made.
I was looking at the dividend yield of TCS. It's there on my screen. It's actually 4%. So where is IT? 10-12% is growth, or 4% dividend yield is value?
Yeah. So I would say IT is in that space where they are broadly they mimic what happens to US growth.
Yeah.
And the other thing is the big myth that currency depreciation helps them. You look at ITC or any of the top 5, their performance over the last 5 years, and currencies roughly depreciated, say about 20-25%, and their margins are down 2% roughly. So this myth that currency depreciation, so basically they have no pricing power. That's the bottom line. And to some extent, they are also commoditized. I mean, they may say as much as they want that they are digital, they are high end, but at the end of the day, there is a part which is high end, and there is a large part which is, really the low end work that they do. And those tend to do well when the US economy is doing well, when discretionary spending, especially for technology, is very high. In a recessionary environment, we are already seeing, sound bites from the likes of Google and Amazon that they're cutting on, workforce.
yeah.
I read something about Oracle last
Yes.
night.
So I think the next, say, 1 year will be tough for them. So it may fall into the value zone, but currently their P's are more on the growth zone. So I think there could be some more derating there. That's my personal view. I could be completely
Yes,
wrong.
no, thank you for that. The house which you represent has a very deep understanding of commodities. You understand the cycles much more than anyone else can. Where is the commodity cycle headed? Is it time to say goodbye to metal stocks now?
So we have split views
It's a
in our
tricky
house.
one, right? It's a
No,
tricky one.
I'm being very honest,
Which
and
side
I've
are
been
you
wrong.
on?
So I've been wrong.
Okay.
So I was of the opinion that crude and non-ferrous will do extremely well.
Crude and non-ferrous will do extremely
Well,
Okay.
and there are others in the group who felt this is time to exit.
Okay.
And as we've seen, that crude is held, but non-ferrous is collapsed.
Okay.
My view on both were the same, that why crude and non-ferrous, because investments in this segment has been very, they have come off almost 50%.
They've been zero.
Yeah, so at least in crude there have been oil. It takes about 4-5 years after you start investing, and if the investments are so low, it takes a much longer time for it to come back. So even pre-Ukraine, if you see, sometime in September, crude was around 80-85.
Yes.
So it wasn't as if we were at 50 mark or 50 handle before. So there was already a pressure on oil. I think it will continue because investments have been very low. We will see a period where crude will be in the 80 to 100 range for a sustained period till we enter this transition of green versus fossil fuel. My view on non-ferrous was also the same and is still the same, that investments have been very poor. And we've seen in this cycle that most companies have actually not announced massive capex, barring say one company.
Hindalco is talking
but
about
even
it,
that, if you see, is more for their overseas entity, which
Novelis
isn't.
they're talking about, yeah.
So most companies have distributed cash, unlike say in the previous era where as soon as commodity prices go up, massive capex happens, and then you have a period where there is excess supply. As economies come back, and that may take some time because there's a possibility of recession both in the US and in China. So this may take some time, but even at these prices, they will still make a lot of money. But for the stocks to get re-rated again, I think it may take some time. So that's how I would say.
You talked about PSU banks, and I want to just draw your attention to private banks as well,
Yes.
because there's so much rotation happening even within the top 5. I mean,
yeah.
who would have thought that Innocent Bank is going to be the new emerging star?
Yeah.
While HDFC and Kotak, to some degree, are going to
Yeah,
continue to
yeah.
underperform. Is there going to be some correction there as well?
So we are very bullish on the entire large cap private sector space. At least our view is that we are entering this dream phase in financials for multiple reasons. I mean, all the stars are getting aligned. So one, if you see, the credit costs are getting normalized much faster than what we would have anticipated, not only for the PSUs, even for the private sector banks. So credit cost normalization is happening very fast. Loan growth is coming back. And as interest rates go up, initially actually most banks end up having a higher margins because your liability gets repriced with a lag, and your assets gets repriced immediately. So we will see better profitability plus growth coming back, and the threat from NBFCs is significantly gone down. Most NBFCs are struggling for whatever reasons. They have their own challenges, barring one or two. I think so the competition for the banks has also significantly reduced. So we think that the next say 3 years maybe golden phase for banks in general, within the financials basket. If you ask me, I'll just buy the top 4-5 banks. I mean, you can argue whether one is better than the other. I think all of them will do well. You pick your stock and just stay put for 3 years. I think there's a lot of money to be made in banks.
Who
Okay,
has the
very
right to
quickly.
win?
Sorry.
No, I'm just a follow-up question on banks. So I can divide the bank into 2 or 3 categories. Really cheap banks, whether it is a DCB or an RBL or a Yes Bank, they're really cheap, almost at book. Then you got these expensive banks, and then you got PSU banks. Who has the right to win in this space?
I'll go with large cap and not get into cheap PSU and very expensive. The larger the bank, the more ability for them to garner more deposits because of the branch networks. As your costs are low, your ability to price your loans and not get into riskier bets is better. So I would just say large cap, which includes a few PSU banks and the 4-5 large cap banks, and don't need to look below that. I mean, the runway is looking so good that do I need to take that extra risk?
I have one more follow-up question. I know we're extending appointment with you today. As a house, you've also tracked cement very well.
Yes.
I mean, the understanding of your house on cement is absolutely class apart. I don't know whether it's a war in cement, but there is a big change in the way how the dynamics would move. Again, if I use the phrase again, the right to win. Who has the right to win in that space now? The existing one or the challenger?
So I think broadly, at least my personal view is that when you have competition like this, it's not great for shareholders, which is you have a new entrant and then you have existing player announcing large capex, pricing isn't stable,
like
you
Jio.
have excess capacity already there. I think this isn't great for shareholders at this point. You're better off staying away, watch the fun, and see if there are opportunities you enter. But on a broad way, I would say that these are times like in telecom we saw, say, 4 years or 5 years back. It was great for consumers, but it was better to stay away as a shareholder. I mean, currently we have a different view on telecom, but I'm just giving you an analogy that it's better to stay away. Do I know exactly how it is going to happen, how pricing will behave, how the egos of managements will behave? I don't know. So I'm better off staying away, right? I have a lot of other options to invest
Is that the case with the new age tech companies as well? They've had a year of learnings and now seem to be, coming back with a revised plan.
I'm happy to see that the plans are getting revised, but we're still staying away. We'll watch from the sideline and see how things progress. Happy to miss the
My
first.
question is specifically on Zomato. You must have guessed.
Well, I'm not giving you a specific
Sure.
answer, but if you see all the new age tech companies that have come, all of them have the same issue, which is the path to profitability is not clear. Now suddenly they're talking about profitability. I'm happy that they're talking. I would want to see some proof of that, and happy to miss the first leg. We can always jump in the second
When they
leg.
walk the talk.
Yes, exactly.
Yeah. Okay. Okay, Sridhar, great having you in
Thank
the
you,
studios.
thanks a lot.
Thank
Thank
you
you.
so much for taking the time out.